Hey, welcome everybody. This is the Profit Flow Analytics. We're doing a little training on this tonight. I'm Mark Dannenberg with Options Moneymaker, and we're talking about Profit Flow Analytics by New Cycle Trading and Analytics. Also with us tonight is Michael Kastner. Michael is the host of the Options Moneymaker Live Trading Room. Hey, Michael.
Hey, Mark. How are you today?
Very well, very
Good,
well.
good.
All right, so we've got some really exciting stuff to share here, Michael. We've had a lot of people that New Cycle Trading has told us have joined and participated in what is really the most simple, profitable signals for futures and options traders. They are an excellent team of traders and some pretty smart programmers, and they've worked with us. We've collaborated with them to put together what we consider to be, a change. It's a it's a life-changing event for a trader to be able to take the types of trades that we're taking. So we're going to do a little training on this tonight. Make sure you really understand, folks, how to most effectively use these charts. So as I mentioned, Options Moneymaker and New Cycle Trading, we collaborated to present a complicated consensus of technical indicators into what we consider to be a very simple single entry signal. And I'm going to show you charts here in just a minute. I'm going to do quite a bit of training and give you everything that you will need to know in order to be able to trade these charts effectively, whether you're a futures trader, options trader, or a stock trader. Now, trading strategies, particularly with options, they are important. However, the most important key success factor is when do you enter a position and when do you exit a position. Profit Flow Analytics is going to answer that question for you. So if you're really just getting started with a chart, you've come to the right place. We're going to give you some training tonight in addition to the training that you received when you actually subscribed to the Profit Flow Analytics. So just some basic guidelines before I actually get to the chart itself. There are two indicators embedded in Profit Flow Analytics. Both of them are summarizing a large number of separate indicators and presenting them to you in a single signal that tells you whether or not you should be long if you're a futures trader, or buying a call if you're an options trader, or if you should be short if you're a futures trader, or buying a put or some sort of a short strategy if you're an options trader. Those two indicators are the profit flow oscillator. This is going to be your primary signal. This is where you should focus your attention first as you're getting used to your charts. The second signal is a trend consensus signal. That's a great opportunity to determine whether or not the trend is continuing or whether it looks like it's weakening, and it gives you an opportunity to take a trade that we might refer to as a continuation trade. All right, so lots of questions we get in the live trading room here at Options Moneymaker are about what time frame should I be using. And we have recently profiled the 1 minute time frame on futures. We've profiled the 5 minute time frame on futures. We did an interview in one of our recent Q&As with one of our clients, Josh, who likes to focus on the 30-minute chart when he's trading his NASDAQ and ES futures. Those are really the most ideal time frames for you to focus on, especially as you're just getting started. In fact, as you are just getting started and you're getting familiar with your charts, I would say that the best time period for you to zero in on first is the 5 minute. There are obviously not as many trades as there will be on the 1 minute, but you're going to get some smoother action and smoother activity out of the 5 minute. And it's a way for you to get yourself introduced to the chart and make sure that you really understand how to properly use the signals. Now, if you're an options trader, what I believe are the most beneficial time periods for you to use are the 30-minute and the daily. Now, when you use the daily, and this applies to the 30-minute also, if I was looking at a signal to say buy a call on a daily chart or a 30-minute chart, I would want to pop over and take a look at the 5-minute chart and make sure that the 5 minute is not disagreeing right now at this moment with that daily or 30-minute signal. So essentially, I'm going to take my trades based on the 30-minute or daily as an options trader, but I'm going to use the 5-minute to actually time the entry. Within a 30-minute bar, price bar, or a daily price bar, there can be a lot of intra-day activity. The 5-minute is the time period that's going to time your entry. So you could be looking at a daily chart. Daily chart is telling you should be buying a put right now or some other short strategy, short options strategy. Take a look at the 5-minute and just make sure that you're not currently in a long cycle. You would want to wait until the 5-minute is presenting a short cycle, and that is actually the way you're going to time the entry of your position. Now, if you're a stock trader, I would say just look at the daily chart. And you could certainly use the 5-minute, maybe even the 30-minute to time your purchase of the stock. But basically, if you're a stock trader and you are interested in buying and then selling at the turn when it looks like the stock is starting to head back lower in terms of price, the daily chart is going to allow you to do that. And I'm going to show you how you can easily identify that. Very simply, when you're entering a new position, you're going to always enter a new position on a dark blue bar. It's really that simple. You're going to always enter a new position on a dark blue bar. When you see a dark blue bar, you're going to go long on a futures position. You're going to buy a call option or other long option strategy, and you're going to buy a stock. A dark red bar means you're going to go short on a futures position, buy a put option or some other short option strategy, or that may be the timing for you to sell your stock. So it's really that simple. You're going to buy on dark blue, you're going to sell on dark red. It's really that simple, and you'll see the chart. If you haven't already, you're going to see the chart here in just a minute. If you've already subscribed to the chart, you know what I'm talking about, but I'm going to kind of walk you through that and give you more examples of that. Now, exiting a position, there's a whole strategy around the exit too. And before I take you through some suggestions for exiting the different styles of trading, I just want to say I think it's very important that you trade in sim mode. That's simulation mode, so you're not risking real money. Sometimes it's referred to as paper trading with options. But I think it's important that you find your own personal trading style, because there are different ways for you to exit a position. So in a futures position, if I am in a futures position, I can exit that position by using a trailing stop. And on the Futures Trading Dome, the broker's platform that I'm using to trade futures, I have that preset, and it's going, when the price moves so that I have a certain level of profit, it's going to kick in what's called a trailing stop, and it's going to automatically follow the price as it continues to move and eventually take me out of the position. It's a very common method for us to exit positions when we are trading futures in the live trading room here at Options Moneymaker. You can also scalp, which means as soon as you have 2 or 3 points of profit, you might want to lock in a point so that you've turned the trade into a potential risk of loss into a no risk of loss trade. Scalping is a good way in a very choppy market to exit a trade. You might only get 1 or 2 or 3 points here or there on each trade, but if you're trading a 1-minute chart, there are a lot of trades that are presented to you throughout the day. But scalping is a way that many of our traders in the live trading room will accumulate their points throughout the day. Another way to exit the trade is when you see a signal weakening on a gray bar print. Now, when I put the chart up in front of you, I'm going to go through all this again, but I just want to have this in the recording so that you can refer back to it as a simple summary. So between the print of the red bars and the blue bars, where you might be going short or going long, there is a gray bar which is kind of telling you or suggesting to you which direction is coming. And so if you are in one position and an opposite gray bar starts printing, that's the first signal to you that the strength of your position might be weakening. So we can use a gray bar exit on the profit flow oscillator. And then there's simply the signal reversal. If you had gone short on a red bar and you're still holding the position and now a blue bar prints, you want to be out of that position because now the signal and the direction according to the profit flow analytics indicators is reversing and you want to be out of that trade. That means you want to be out of that trade even if it's a small loss. You definitely want to be out of the trade if you're locking in a profit. Now, general guidelines in terms of exiting an options position. With options, a lot of traders have a fixed profit goal, so it might be a percentage. Maybe you want to make 10% or 15 or 20% on each of your trades if you can do that. Maybe you have a fixed dollar amount. So whatever you use as a guideline, that is one way for you to exit the position. And then the other two are very similar to the futures. If you see the signal weakening with a gray bar print and you're long, you're holding a long call, and you see the gray bar starting to reverse and print below the zero line, you probably either want to lock in your profit or at least put in some sort of a bracket order to protect the profit that you have. And then, of course, a signal reversal. If you're in a trade and the signal reverses, you don't want to continue to hold that trade. And then with a stock position, it's pretty straightforward. You either have a fixed profit goal, or you see the signal weakening on a gray bar print, or you see the signal completely reverse. All right, let's jump over to the chart. So I have to switch screens here. All right, so what I'm showing you here is NQ. This is the NASDAQ 100 futures, and I'm showing a 5-minute chart. The profit flow oscillator and the trend consensus are the two indicators that are part of the overall profit flow analytics chart. New Cycle Trading, they put a lot of thought into this. We collaborated with them, as I said, because we had a very strong set of consensus of signals, technical indicators that we were trying to put together in a very simple format so that it wasn't so complicated to be able to identify the signal. And so we worked with New Cycle Trading to accomplish just that. So let's start with the oscillator because this is where the majority of your trades are going to come from. The dark blue bars are where you're entering a position. And generally, with rare exception, you're only entering on the first blue bar in a series. Generally, let me repeat that, generally, with rare exception, you're only entering on the first blue bar in the series. So what we saw leading up to this blue bar print were two gray bars that were stacking higher above the zero line. So there's a zero line here that you can see where all the blue bars are above the zero and all the red bars are below the zero. So this is a 5-minute chart. So we knew over the previous 10 minutes that we were setting up to possibly want to go long on a futures contract. Or if you were looking at a chart, a stock chart or an ETF chart or any kind of a index, cash index chart of the major indexes, and you were looking at the signal, this is where you'd be buying a call. And you could see it setting up, leading up to it. So what this tells you is you know that when the first gray bar prints that there's not going to be a blue bar after it, because there will always be at least two gray bars ahead of that signal. Well, if you're trading a 5-minute chart, that gives you an opportunity to step away, keep an eye on your countdown clock as the second gray bar starts to expire. You want to see whether or not there's going to be a third gray bar, which sometimes there will be, like over here, and whether or not you're actually going to get a print of your signal to go into the position. So the same thing applies to the red bars. You're going to see at least two gray bars preceding the red bar, and on the first red bar in the series, you're going to go short. Or if you were looking at a stock chart, an ETF chart, or index chart, this is where you'd buy a put or use some other sort of short options strategy. So once we're in the position, by the way, I think that New Cycle Trading has done an outstanding job of making it just about as simple as can possibly be to get into the position. You can trade whatever time frame you want. Like I said, we're on a 5-minute NQ chart here. But it's once you're in the position that now your personal trading style needs to kick in a little bit. And there are 3 ways that I would tell you you could exit out of this position. One is by holding the position until the signal reverses. So I'm just going to use this as an example. Now this that I'm using as an example, we could use any of them in here. We'll use multiples, but this happens to be at 5:30 a.m. on September 11th because this this futures trades nearly 23 hours a day. So you can trade whenever it's convenient for you. The signals work just as well no matter what time of day you're trading. And obviously, during the regular market hours from 9:30 a.m. Eastern to 4 p.m. Eastern, you're going to have a bit more volatility and generally a bit more action. But just to use this as an example, let me walk through the exit methodologies. I'm looking at the data window up here when I highlight the bar, and it tells me that if we had gone long on the 5:30 bar, that we'd be in at 78.04. Now, there's going to be some slippage here, so for the sake of our discussion in this session, I'm not factoring in slippage, but there will be slippage of, a tick, 2 ticks, 3 ticks, a point. In much more volatile markets, it could be more slippage than that, maybe a 1.5. But let's just work on understanding the methodologies for exiting. So if we're in at 78.04 and we're using a 10-point trailing stop trigger, which we frequently do in the live trading room, then you can see that on that 5-minute bar, we moved from 78.04 up to 78.08 and a quarter. That was the high. So that was a 4.25 point move. Now, it hasn't hit a 10-point profit yet, so it has not hit our trailing stop trigger. If we fast forward here and we get over to the 550 bar, so 20 minutes later, remember we're in at 78.04. At 550, we move up to 78.1375. Just 1 tick shy of hitting our 10-point trailing stop trigger. So we're continuing to hold, and then at 6 o'clock, we've held the trade for a half hour. It actually hits our trailing stop trigger, and so we've taken about a 10-point profit on that. Again, I'm wanting you to understand the concept. There might be some slippage on there. There's going to be a little bit of a trail on that trailing stop trigger. But for all practical purposes, you just made 9 or 10 points in that half hour. And on NQ, each point is worth $20. So you've got about $200 of profit in that half hour. That's really, really simple. The trailing stop trigger is a great method, especially for those of you who are just getting familiar with your trading platform. So let's go back to our entry, and let's talk about another method of exiting. Remember, we're in at 78.04, and after we entered, we actually dropped down to a low of 77.98. Now, it's really important that you have some sort of a protective stop. So when you're using a trailing stop trigger of 10 points, we, in the Options Moneymaker live trading room, will usually use either a 10-point protective stop or a 6.5-point protective stop. Generally, we're going to use a 10-point protective stop for the first 1 or 2 trades of the day. after the regular market opens. After that, we typically find that if the trade is going to pull against us 6.5 points, it almost always pulls back the full 10. So we adjust our stop to 6.5 points. So what we're working with is a situation where we'll get into the trade and we will either make 10 points because it hits our trailing stop trigger, or we lose 6.5 points. And if we lose the 6.5 points, we just move on to the next trade. So here, because we're in at 78.04, it pulled back to 77.98. It pulled back 6 points, but not 6.5 points. So it would not have hit our 6.5 point stop loss. And then we already know it went on after 30 minutes to hit our 10-point trailing stop trigger. So that's the trailing stop trigger with a 6.5 point protective stop. That's the first method for you to exit out of a trade potentially. It protects you from a huge move that came out of nowhere, which can happen sometimes, like this one just dropped, what did that drop? 23 points. Yeah, you don't want to be in a long position when something like that happens. You want to protect yourself, and if you take 6.5 points of loss, then that's pretty easy to recover from. The next method would simply be to stay with the trend. Now we can, in hindsight, see that the price was continuing to move higher in some higher lows and higher highs, a whole sequence of higher lows and higher highs. So how do we stay with the trend? Well, there are two ways to do that. One would be you're in this trade at 78.04 and we're long, but now at 6:25, so we're coming up on an hour holding the trade, we can see that we have a gray bar printing. And that gray bar is telling us that we might be seeing a weakening of this rising cycle. And so this is the method that we use when we're trading this exit methodology. You can adapt it to whatever you choose. I'm here to tell you what I know works. So what I would do is I would pay attention to that bar, but I'm going to wait for 5 minutes to see if it actually prints. There are periods where you're going to get a flash of a gray bar that looks like it's opposite your trend, and then it comes right back up and actually moves back into another sequential blue bar. So if it did actually print on the open of the next gray bar, that would confirm that we have a fully printed gray bar. We would exit out of the trade. So in this case, we'd be exiting on the second gray bar, at the open of the second gray bar, which is 78.12.5. So in that case, we would have made 4.5 points. So we're in at 78.08. Did I say that right? We're in at, sorry, 78.04 to 78.12. We made 8.5 points. So the trailing stop trigger took us out for about 10 points. Holding until the gray bar exit took us out for 8.5 points. Then the third method that we would use would be getting in at 78.04 and then just simply holding the position until the first red bar starts printing. So in that case, at the open of that red bar right there, we'd be out at 78.14.75. So you've got just over 10 points of profit. So all three of those methods in this example give you the reasonably similar result. That's not always going to be the case. And this is why I think it's important for you to learn and understand each of these methods and trade it in sim mode. Trade it in sim mode. Now, the one caveat with holding the full cycle from the first blue bar to the first red bar is typically, if we are going to do that, and we don't do a lot of this in our live trading room, but if we are going to do that, we're going to do that without a stop. or if we do have a stop, it's going to be a 20 or 30 point stop, just to protect us from any kind of a unforeseen huge move. But basically the idea of that method is to follow the cycle until the cycle reverses. That's what that method is all about. So if you're just starting out, do that in sim mode, decide what you're comfortable with in terms of a protective stop, but maybe for your initial trading, and some of this will depend on the size of your account, use the 6.5 point protective stop and a 10 point trigger, or if you're not out of the position yet, a second gray bar print. So that's how we would look at a 5 minute. Now, let me just kind of give you some numbers from this week, for example. If you traded the 5 minute this week using a 10 point trigger, Monday, you made 13.5 points. Yesterday, you lost 6 points. And today, you made 20.5 points. So it's 34 points for 3 days of trading this week. That's using a 6.5 point protective stop and a 10 point trailing stop trigger. If you used the gray bar exit with a 6.5 point trailing stop, or sorry, 6.5 point protective stop, Monday was 52 points, really strong. Now the reason is because that method allows you to stay in a strong cycle. Whereas if you're using a 10 point trailing stop trigger, it's going to take you out after 10 points, even if the cycle runs 30, 40, or 50 points. But the advantage to the 10 point trailing stop trigger is it may give you the peace of mind to just lock in your 10 points. And if you took 2 trades like that each day, 20 points is $400 a day. So some of this choice that you have is going to be dependent on what you feel your account can handle, what your own personal risk tolerance is, and what your objectives are for profits. So Monday was 52 points. That's the gray bar with a 6.5 point protective stop. Monday was 52 points. Yesterday was break even. You didn't make anything, you didn't lose anything. And today was 37 points. Now, what I want to be really clear about here is these numbers that I'm sharing with you are trading from 9:30 a.m. to 12 noon Eastern. It is not all day trading. These numbers are from 9:30 a.m. to 12 noon. So your total points on the gray bar exit for 3 days are 89 points. And then the reversal, which is always going to have the greatest amount of drawdown risk if you have no protective stop. It's always going to have the greatest amount of drawdown risk, and generally it's going to have the greatest amount of profit opportunity. So there is that equation that you have to weigh to decide how much risk you're willing to put out there. Are you willing to hold a position through a 30-point drawdown waiting for the next reversal bar to print? I can't answer that for you. That's something that you're going to have to decide for yourself. Monday, if you had just strictly traded on the reversal with no protective stop, you would have made 48 points. Yesterday was 1 point. Yesterday, there was more chop. The signals weren't following through. We saw that on the other 2 methods also, but yesterday you would have made 1 point. And then today you would have made 52 points. That's all before 12 o'clock. So for the week, you're up 101 points. So the reversal for this week so far is the best performing. The gray bar exit is the next best performing. And then the 10-point trailing stop trigger with a 6.5 point protective stop is the lowest performing with 34 points, but that one also has the least amount of risk. You're in the trade for the least amount of time compared to the other 2 methods. So there's a balance here between how much risk you're willing to put on initially, how much risk you are comfortable holding through, and whether or not you have the emotional peace of mind to be able to hold for a full reversal, which in this example would definitely have given you the highest performance, but you also may have the highest amount of anxiety while you're holding through a 30-point drawdown. All right, so that is what you do with a profit flow oscillator, entering trades and exiting trades. Now, where the trend consensus comes in is it's particularly beneficial if you're using a 10-point trailing stop trigger. So for example, if we had gotten in here, first bar print, we're in that bar at 78.33.50, and on that same 5-minute bar, we went up 20 points. We went up 20 points, so it would have hit your 10-point trailing stop trigger. So you're out of the trade. And afterwards, you know, the emotional side of you may look back and go, yeah, but I missed all that upside. How do I get part of that? Well, since you're out of the trade on the first bar, then the next validation that you could get back in is when your profit flow oscillator is continuing to print long, tell you to go long, and your trend consensus comes on with a dark blue. Don't take the light blue, but with a dark blue. So when they are aligned, you have alignment between the two indicators. You could take what we refer to as a continuation trade, and in that case, you'd be in at 47.50, 78.47.50, and 2 bars later, it goes up to a high of 68. So just to kind of rewind a minute, by the way, you can set your trailing stop trigger for whatever you want. If you had your trailing stop trigger set at 20 points, there's 20 points on the first trade here and another 20 points on the continuation trade. You've got 2 trades for 40 points. And it's generally never one single method. So for example, you may set your trailing stop trigger at 20 points instead of 10, but you know that as soon as you've got 6 or 7 points, you're going to lock in 5 by inserting a manual stop. And when you're out to 12 or 13 points, you're going to lock in 10 manually. So what you're doing is you're manually locking in profit while you are allowing the price to continue to move closer and closer to your 20-point trailing stop trigger. Use whatever you want for a trailing stop trigger. You can either just let it be and hope it hits that, or you can lock in points along the way. But here's a great example of this trade. This was today on the 5-minute. If you'd gotten in at 9:45, you could be out for 10 to 20 points. And then you've got a continuation trade at 10 o'clock, and there's another 10 to 20 points. That's pretty easy. All right, so I want to back out to a daily chart here, and I want to pull up a stock. So let's take a look at Amazon, for example. A lot of people trade Amazon, trade the FANG stocks. Let's just kind of take a look at how these signals work. You see here, there's a whole series of days. Remember, now we're on a daily chart where there's no signal for you to take. And yes, there was a nice little sell-off on Amazon during that period of time, but the reality is we're going to follow the signal. We're going to follow the signal, and we're not going to be tied up into the emotion of what we might have missed out on. All we care about is what we can grab for ourselves. So here on June 7th of this year is a signal to buy Amazon. Now this might mean you're buying a call or buying a call debit spread, or you might be opening a put credit spread, anything that is a long options strategy. You can use that signal to enter, or it may just simply be buying the stock. So on that particular day, June 7th, let me just look at the price here. June 7th, the day opened at 1763.70. Well, on that day, the price moved up 43 points. So if you're an options trader and you're trading a 50 delta, you got 20 points of profit. I'm probably going to grab my profit and then I'm going to wait for my next signal because I have an opportunity potentially to see a signal most every day if I want to. But if I wanted to hold because I am more of a cycle trader, new cycle trading, then I'm in at 1763 and my second gray bar exit takes me out at 1912 or my reversal takes me out at 1911. So that's a pretty strong trade right there from 1763 up to, let's just say, 1911. That's a pretty strong trade. And again, at a 50 delta, if you're holding an option, that's a really strong, profitable trade for you. Now, overnight with stocks, you know that there's always a risk of gaps. Just because you're holding a long position and it's profitable when you when the day closes doesn't mean that the next day is going to open and it's profitable. And there are ways that you can get around that with some pretty simple options trading strategies. You can leg into a debit spread in order to protect the profit that you have. You can take off that short leg the next day if it's continuing to move favorably for you, but you protect yourself overnight. So there's some simple ways to do that. But strategy aside, what the profit flow analytics and particularly the profit flow oscillator are offering you is the opportunity to know when to get into a trade. Now, there are going to be some that don't work out, or they appear they don't work out. So let's just take a look at this one here, for example. On March 27th, there was a signal to buy a put or use some sort of a short options strategy. The day opened at 1784. It is actually down 40 points that day, but you don't know what the next day is coming. What you don't know is maybe there's another 100 points beyond that. So this is where I think it'd be good to lock in your profit using a legging in strategy on a debit spread. But if you didn't do that, so 1784, and you use the second gray bar exit, you're actually out of the trade at 1811. So in that case, you've lost about 27 points. 50 delta would mean you're losing about $13, $14, somewhere in there. You're going to have some losing trades. But that trade had opportunity for profit right up until that 2 gray bar exit. Now, what's interesting is, and this is not something I would recommend for anybody. I don't know that anybody really has the cast iron stomach for this, but if you took that trade to go short at 1784 and you held through all the neutral bars, you held through everything until you have your first reversal, you're actually out of the trade at 1763. So through that period of time, from March 27th until June 7th, you've got a lot of time in that trade, and you made basically 20 points on that trade. 20 points, which is only 10 points on an option. And somewhere in there, you would have been rolling out the option. So the point is, you need to modify your strategy using one of the exit methods that I've talked about, but you need to modify it to your own personal trading style, what you feel most comfortable with. For me personally, if I'm trading an option and I have a 20%, 25% profit in the same day, I'm probably going to take it. If I'm trading an option and I've taken the signal to get in and we're getting close to the end of the day, I'm probably going to leg into a spread so that I can protect the profit that I have, and then I can evaluate what I want to do the following day. Now, one of the last things that I want to share with you here before I take some questions is the 30-minute is a common denominator time period. The 30-minute can be a very, very lucrative, profitable time period for futures trading. It can also be an excellent time period for options trading. If you look at the 30-minute and you see a signal setting up, you can take that signal, but what is suggested is that you are using the 30-minute as your primary trigger, but as soon as you see that signal, check in on the 5-minute and make sure that you don't have an opposite signal brewing. Because on the 30-minute chart, the longer the time period, the more likely it is that the price could move against you before it moves for you. There's just more room for it to move within that 30-minute bar. So here's an example of a trade at 12:30 on the 5th of September. And you can see now in hindsight that it kind of trickled a little higher here. Let's just check in and see what 12:30 on September 5th on the 5-minute was doing. I don't know the answer to that, so let's just see what it was showing us. September 5th, 12:30. There we go. Okay, September 5th, 12:30. Yeah, see, I would not have taken that trade immediately because the 5-minute, although it's a gray bar, it's above the 0 line, which is hinting that we might be in some sort of a move higher. And the 5-minute actually didn't give me a valid confirmation of my 30-minute short signal until 3:30 that afternoon. So if I go back to my 30-minute and I go back to the 5th, yeah, 5th right here at 12:30, at 3:30 in the afternoon, then I wouldn't have taken the trade because at 3:30 in the afternoon, my 30-minute chart actually is neutral. So that's a trade that I would have avoided getting into. And that worked out. That helped me out. So the 5-minute is a great validation for whether or not your 30-minute signal is ready to take advantage of now, or should you wait? So before we get into any questions, Michael, I'm just wondering if you had anything you wanted to add in terms of the use of the entry or the exit. Michael does quite a bit of trading on the 5-minute chart.
Yeah, Mark. I would like to just a real time deal. Look at the 5-minute that just happened. I actually took that trade at 7:25, I think it was.
Yeah. So remember, folks,
and I'm already out.
NASDAQ trades overnight. So you took the 725 trade.
Yes, took the 725 trade, and I actually got in that trade right at 34.5 is where I entered the trade at. So okay. I had a half a point of slippage on that.
Right, 2 ticks of slippage, 79.34.5, and on then, that bar, it looks like it went up to 62.
It did, but of course, yes, it did. Yes, absolutely.
Yeah. So if you're using a 10-point trailing stop trigger, you're out for your 10 points because it went up actually 28 points.
Right.
On that 5-minute bar, up 28 points.
It did.
And if you're using a 20-point trailing stop trigger, it would have hit your 20 points. Now, along the way, I'm sure Michael locked in 5 points, or if it got out beyond 10, would lock in 10 points, because you just don't want them to come back against you. If you have 10 points of profit, locking in 5 makes a lot of sense so that it can't come back to being a losing trade.
That's correct.
So that's.
But I just exited the trade on the gray bar. I'm waiting for this next bar to print, then I'll be exiting. I'm still in it.
Okay, so this will be interesting. We'll take a couple of questions and we will see. Now, we're not actually exiting on this first gray bar here, folks, because what can happen frequently is during the print of that gray bar, it may flip back up to being a blue bar again.
Mm-hmm.
And we might see this continue higher. The second gray bar exit is allowing us to see a full print of the first gray bar, and then we would exit at the open of the next gray bar if that does print gray.
That's correct. But I do have a stop at 10-point profit. I'm taking care of that, because if it does pull back, I'm going to make 10 on this trade.
Yeah, see, that's a textbook trade right there. So Michael's got a trailing stop trigger that's out beyond 10, and he actually has a profit that is well beyond 10 points right now. But he's going to let it run, and we'll wait and see what the gray bar does to take us out. But he converted a trade from being a risk trade with a 6.5 point stop risk to a no risk trade, guaranteed, can't do worse than make $200 on the trade per contract.
That's right.
That's a great trade right there. So one last thing I meant to point out here. This is one of the reasons, if you've seen my emails where I'm talking about new cycle trading and what we worked together to create, I keep referring to this as a very powerful indicator. The main reason I refer to it as a powerful indicator is the size of the drawdown. Now, a drawdown is where you open a position and it moves against you, it moves against the direction that you would like it to. The size of the drawdowns on the 5-minute chart are smaller than we have ever experienced with our original traditional AO to AO strategy. The AO to AO strategy produced outstanding profits but had pretty sizable drawdowns to them. The drawdowns are unusually small here, which is why typically we're using a 6.5 point stop loss, because if it hits 6.5, it's generally going to go beyond that. That's our experience. And in this trade that Michael's in, the opening of the bar was 79.34. The low of the bar was 79.33.5. So we actually had 1/2 of 1 point of drawdown on this trade. That's why I love these signals. That's why these signals give me great peace of mind, and why I think every single person who's serious about trading ought to be using these signals.